Welcome back, everyone, to the Risk Intel podcast, powered by SRA, where we share risk intelligence from experts across the banking industry. I'm your host, Ed Vincent, Executive Vice President at SRA. Michael, we've talked about improving the safety and soundness of the FinTech ecosystem. And you've also talked about how in prior stages of regulatory oversight, there was guidance around managing vendor relationships. And so one of the questions that we get asked a lot is, why is FinTech management and monitoring different from that traditional vendor management, which is in that practice that has been around for years and decades? So can you share your thoughts on the key differences between a vendor and a FinTech, and the vendor management function and the FinTech partnership function?
Yeah, and let me, Ed, first start out and say, at one point in time, a few years ago, they were one and the same. And there's extensive regulatory guidance that you all are aware of around managing vendors, and it's come out, 2 or 3 different times, and it keeps getting heightened. And so vendor management was all about, reducing the risk of your vendors. And about 2 years ago, then the guidance came out specifically on FinTechs, and it changed everything. And it changed everything because the vendor management guidance didn't change. So all your vendors that you're managing, your process was still uniform and sound. But for your FinTechs, the bar was substantially raised. Now, the big challenge, Ed, in the industry is, what's the difference between a vendor and a FinTech? Wow. And let me address that really quick, and then talk a little bit about what those extra requirements are on the FinTech side. A FinTech, in regulatory definition terms, tends to be an outside technology company that is originating customer loans, customer deposits, customer payments, or has some impact directly with your customers' account balance, whether that be loan account, deposit account, transactions. And so now when the regulators see that an outside FinTech is interfacing with your customers in some way, and they're not regulated, it scares them. And that's why that guidance came out. They said for those and the term FinTech might be even broader, and a lot of people define it differently. But the ones the regulators are concerned about is really those technology companies that impact your customer in some way directly, their accounts. It impacts their accounts directly in some way. So without the guidance that came out in 2021 in August of FinTech monitoring guidance, things would still be the same. So the root of that, that change came from the guidance. But regulators did something that they always do. They take the guidance that was issued, which was guidance, and it was not a regulatory action. It was seen as guidance, and then they put more and more emphasis on it. They put more and more requirements on it. And I think, I could be wrong, but I think the objective of the regulators is to slow this down a bit. They're concerned with the fast growth of hundreds and hundreds of FinTechs doing business with banks. So if they, put this additional guidance on the banks, first of all, if the banks comply with them, then they feel good. Then they feel better about it. But if they don't, then it allows them to slow the bank down with written agreements or consent orders or matters requiring attention. And in their mind, it helps the safety and soundness of the banking system. And it actually might, from a regulatory perspective. So, you know, and the basics around defining a vendor in a fintech, my advice is with those fintechs that you know are fintechs that you have to do the monitoring on, they affect your customer accounts directly in some way. You need to make a list of those fintechs, have them approved by your board, and say, this is the extent of our fintechs, here's who they are, and here's the function they perform. Because then when the regulators come in and define other vendors as fintechs, you can say, oh no, we've gone through the process, it's only these 6, we've had our board approve them. The other ones we've determined are vendors and not fintechs because they don't affect customer ongoing account maintenance, management, growth. So I would have that protection. And then, you know, make sure you put that risk maturity framework in place and identify, you know, all the key things you need to do to have the right infrastructure measured and monitored, and make sure you're measuring and monitoring those fintechs to the guidance. And by the way, if you read the guidance, there's over 100 areas that they want you to look at. So I would write each one of those down and have each one of those in your particular checklist. Ed, I'm sure I missed some things there.
I think you're right on the mark there, Michael, that the fintech distinction is focused on those higher risk vendors, the ones interacting with customer balances, and that the regulatory guidance lays out very, in a lot of detail, the level of scrutiny that they expect the bank to put in place from an evaluation and a monitoring perspective, right? It's over 100 attributes there and key risk indicators. So, making sure that you can defend why a partner falls onto the vendor category versus the fintech category is step one. And then step two is making sure that when someone does fall into that fintech category, that they are evaluated against that guidance that is out there. And ideally in a way that you can then track that and monitor it over time. Thanks very much, Michael.
Thanks.